Hi guys, welcome to another episode of PPTV. It's me, Beth here, and I have an amazing guest today. It is Shaz Nawaz.
Hi everybody, and hi Beth.
Hi, thank you for coming.
Thank you for having me.
I know we've been trying to organise this for quite some time, so we finally did it.
It's been months and months and months, hasn't it?
Yes, it
Well,
has.
we're here finally. So.
We're finally here. We've got lots of questions from you guys from some of our recent posts. So we're going to be running through them now today, and any extras that you might have, feel free to pop them in the comments. If we have time, we might be able to answer them. If not, we can look at those at a later date. But shall we get stuck in?
Let's get started.
Let's get stuck in. So one of the main questions that we got is it possible to pay less tax? I mean, tax people think is set in stone. That's what you pay, no questions.
Well, the tax rules are set in stone, but like any other piece of law or legislation, there are lots of grey areas, so it depends on interpretation. And the UK's tax system, and anybody who's heard me speak on stage will know I do share that our tax system is one of the most complicated in the world. So there's so many different rates, reliefs, allowances, exemptions that people can claim, but they often don't claim because they don't know about it. So in short, yes, it is possible to pay less tax by ensuring you claim all the particular rates, reliefs and allowances.
That's fantastic. I know a lot of people will be like, yes, this is great.
Well, as you can see, and no secret, I've got a list of 78 different things here, so I might pick on these as we're going through the questions, just by way of example.
Yeah, no, brilliant. So another question that we got quite a lot was...
In fact, shall we cover that now in terms of, is it possible to pay less tax?
Yeah,
so
go ahead.
One prime example is, if you receive, so if you're a basic rate taxpayer, 20% rate taxpayer, you can get £1,000 interest without paying any tax. If you're a higher rate taxpayer, i.e. 40% taxpayer, you can earn £500 interest free, but tax free interest every single year. A lot of people don't know that. A lot of property investors tend to work from home. Not all of them, but quite a few of them do. So you can claim use of home as office. Unfortunately, lots of people tend to use HMRC's fixed rate, so they'll claim £2, £5, £7 a month. Whereas if you use the second method, which looks at your fixed costs and your variable costs, you can claim anywhere from, let's say, £150 all the way up to I think the highest we've done is about £850 or thereabouts in round numbers. So you can claim that. If you're taking dividends from your company, you can get a £2,000 tax-free dividend every single year. If your income is less than 16,850, you can get £5,000 by way of savings allowance. So if your income's 11,850, you get an additional £5,000 for a savings allowance, and you pay no tax whatsoever. If you have your own car and you use it for business purposes, you can claim 45 pence a mile for the first 10,000 miles, and thereafter 25 pence a mile. That starts from the tax year, so from the 6th of April all the way up to the following 5th of April. Lots of people use their car, Beth, and they don't claim the mileage allowance. Of course, if you have a company car, better if it's through a sole trader partnership or a LLP, but you can claim all the costs, including interest, wear and tear, repair, maintenance, insurance and the fuel. All you do is hold back a small element for private use. So you work out how much of the car you're using for business purposes. Let's say it's 75%, so you claim 75% of those expenses through the company and 25% personally. When I say company, I mean business in terms of sole trader partnership or a limited or a LLP. So those are 3 or 4 quick things people can do. Some might be doing those, some might not, but we'll go through a few others as we progress this conversation.
I was going to say that. So within like 2 minutes, you've just reeled off, like you said, like about 4 things that can save you in tax, which I didn't even realise was like even a possibility.
There you go.
So that's fantastic. I hope you guys are taking notes because I think this is going to be very beneficial to you all.
I'll squeeze one in.
Oh God.
Which I think is quite important. So there's rent a room relief.
Okay.
So if you rent out a room in your house and you give access to somebody to your kitchen and to your bathroom, you can earn £7,500 tax-free every single year. So if there's 2 of you who own the property, so let's say husband and wife or civil partners, you both get £3,750 each. So if you're looking at doing serviced accommodation, for example, you could try that from one of your spare bedrooms. If you have a spare bedroom, earn £7,500 up to £7,500 and pay no tax whatsoever.
My mind is
above
really
and beyond
blank.
your personal allowance.
That's amazing. And I just think a lot of people, they don't know that this is even an option, which is why everyone's so like, wow.
Yeah.
But that's great. One of the next questions that people had was, you have to even tell the taxman if you're letting out
You have
your property.
You have to, absolutely.
You do.
So as soon as you buy your property and you start renting it out, you have to complete a CWF1 form, which you can get online. You tell HMRC that you've got rental income, and then they start issuing you with a tax return. If you fail to do that, they'll give you a £100 penalty, and then that penalty increases with time. Of course, if you don't tell them, then you won't be able to file your tax return. If you don't file your tax return on time, but they'll give you a further £100 penalty, and then that penalty increases with time too. So you have to tell them, even if you're making losses, you have to tell HMRC.
It's almost a domino effect then, otherwise.
If your income is less than £1,000 a year, then you don't have to tell them. But I'm going to assume most property investors listening to this particular interview will have more than £1,000 income.
Brilliant. So this one kind of links back onto what you were just discussing if you kind of co-own a property. Someone's asking, I heard if I split the ownership of a property, do I pay less tax?
So an accountant and a lawyer's best friend or best answer is it depends.
Okay.
So let's run through a scenario. Let's say we've got husband and wife. Husband's a high rate taxpayer, so he pays his tax at 40%. So any rental income profits, okay, would be taxable at 40%. And let's imagine his wife or his husband doesn't work, then they'd be better off splitting that income, so giving half, for example, to the other partner to use up their personal allowance. So you'd save 40% of whatever you give to them. If they are, say, earning £15,000 a year, they would then be a basic rate taxpayer, so they're paying tax at 20%, you're paying tax at 40%, so better to transfer some of your profits to them, so you're still saving the 20% margin. So it depends. If you're both paying tax at the same rate, i.e. you're both higher rate taxpayers, there's no benefit. But usually what I find is one partner or spouse tends to or may earn less than the other, in which case you want to use up those basic allowances first.
Just to kind of even it.
To even it out. Yeah. And if you're a basic rate taxpayer, so let's assume your income's £25,000, and let's say your partner works part-time, let's just say in a school as a dinner lady, for example, and she earns £6,000. You can use 10% of her personal allowance. Okay, so she gives you 10% of her personal allowance. That means you're going to save £238 a year in tax, and you can go back 4 years up to 2015. So if you haven't done that and your partner's not been using up their personal allowance, go back 4 years, use up 10% of their personal allowance, and you'll get £238 back every single year. That will probably add up to just over £1,000 or thereabouts.
That's great. I would never think that you could backdate it like that, especially for 4 years. That can be quite a big chunk just there.
Yeah, it's not bad.
That's a great tip.
In fact, it's just under £1,000, but yeah.
That was quick maths. That was too quick for me. A lot of the other questions are about setting up a limited company then. Do they have to do it? Should they do it? The benefits tax-wise of setting up a limited company? That's
an interesting one, because where we are right now with Section 24, and I'm sure most of our listeners stroke viewers will know that if you run your property business or a buy-to-let business through a limited company, Section 24 does not affect you for the time being. Those rules might change, but let's work with the rules as they are.
Okay.
So that's a big benefit of running a property business through a limited company. The other benefits are it gives you limited liability. So as long as you haven't given any personal guarantees, if you have to go bankrupt, or if the company has to go bankrupt, you don't have to, they can't take your house away, they can't take your personal assets away. Of course, corporation tax is at 19%. So let's say somebody who makes £30,000 profit a year, they would only pay 19% tax on their profits. If they take that money out, then they may have to pay additional tax depending on how much they take out. So from that point of view, a limited company is better. You then get your £2,000 tax-free dividend. So if it's husband and wife, you can both earn 11,850 using up your personal allowance, which gets you to 22,000. You then get £2,000 each for your tax-free dividend. So from the £30,000 profit, after you've paid the tax, the rest of the money you take out tax-free. But the big reason is, if you're looking to reinvest all of your profits into buying more property, which most property investors do. How do I know that? Because I do exactly the same thing. So I've got plenty of time on my hands, but I haven't got plenty of cash, Beth, because I'm always looking for the next deal. So if you're looking to reinvest, if you're a sole trader or a partnership, and let's stick with our example, you've made £30,000 profit, you're going to have to pay tax on that £30,000, even if you reinvest a whole lot. Whereas if you're a limited company, you pay 19% corporation tax. The rest of the money stays in the limited company. You don't take it out personally. You can then reinvest that. So if you're a high rate taxpayer, personally, you'll end up paying 40% on the £30,000. Whereas if you're a high rate taxpayer and you have a limited company, you're only ever going to pay 19%. The rest you can reinvest in further deals. So I've quickly gone through that. I know I've run through numbers, but how's that kind of make sense to you?
Yeah, no, that makes sense. My next question then would be, who wouldn't this suit? So you said it suits a high tax rate payer. Who wouldn't a limited company suit?
So if you've got property losses, then best to use up those losses before you think about incorporating your property portfolio. Okay, do not do that. Also, if you haven't got any other income and you're a basic rate taxpayer, or your profit is say £20,000 a year, and there's two of you who own the property, let's stick with the husband and wife example for now, okay, then being a limited company may not benefit you because you're not exceeding your personal allowances for the year. So just keep it simple and just have a standard partnership.
Brilliant, thank you. That makes sense to me, so it should all make sense to you guys as well. The next question we touched on a bit at the start was simple changes that you could do today that could start saving you money where tax is concerned.
That's a big,
vague
question. So what I'm going to do now is, if you don't mind, I'll just quickly run through my list, and we'll pick out a few. Perhaps we've covered a few too. So if people aren't making payments into a pension scheme, that's usually a good one. Of course, you'll have a cash flow disadvantage because once the money goes into the pension pot, you can't take it out. When you reach 55 years of age, then you can take out 25%. But any payment that you make into a pension, up to £40,000, okay, you get tax relief on that. Also, if you haven't made any contributions in the last 3 years, you can carry those forward. So every year you get £40,000. If you've made no contribution in the last 3 years, so you got £120,000 to carry forward, plus £40,000 this year. So if you had a whopping year, let's assume you've done a commercial conversion and you've made £150,000 in profit after tax, and you're thinking, I want to reinvest this, but I'd rather put it into a pension plan and pay no corporation tax. You could put the entire amount into a pension pot. Let's say you can use a SAS, okay, a small self-administered scheme. Put that entire amount into a SAS, and you won't have to pay any corporation tax on the £150,000, which at 19% is going to be a pretty big number, something like £30,000 or thereabouts. So that seems to work exceptionally well. We've covered the £1,000 interest for a basic rate taxpayer, 500 for a high rate taxpayer. We've covered the marriage allowance of 10% to ensure that you use up your personal allowance every year. There's so many people who don't use up their personal allowance. We've covered the £2,000 tax-free dividend. We've covered the £5,000 savings allowance. We've covered mileage. We've covered the £7,500 for rental room relief. We've covered using your home as an office. You can, if you make charitable donations, you get tax relief on that. So make sure you do that. That seems to work well. This is a good one. If you employ people in your business, i.e. employees, you get a £3,000 employment allowance every single year. So the first £3,000 of employers NIC, you don't have to pay up to £3,000, but you have to claim this particular allowance.
Okay.
There's quite a few people out there who probably do employ people, but they are not claiming their employment allowance. So make sure you claim that, because that's a really good one.
Yeah, no, that's great. So how is that easy to find on how about claiming it?
Yeah, just type in employment allowance, go online, you can do it. If you have a payroll assistant or an accountant or a bookkeeper and they do their payroll for you, they should have ensured that you've claimed your employment allowance.
Yeah.
But if they haven't, you can go back to them and say, hold on a moment, why have I not been claiming this?
Brilliant. That's a great tip there, I think, especially because a lot of people, they're branching out and have more teams now working with them in their property business. Yeah. I think that's a great tip. Any more that you want to run through, or shall we move on?
We'll go through a few more.
So we can come back to those. So the next one then was, is Brexit, very topical, going to have a big impact on the tax that I pay for my properties?
So, being a local politician, I'm very interested in Brexit, and I put the news on every day, and I'm trying to anticipate what's going to happen tomorrow, and things change by the hour.
They do.
But if Brexit goes ahead, which is looking likely right now, unless we have a people's vote or something else changes, we've got to pay best part of 39 billion pounds or euros to the European Union. They're going to change all of our systems, but without boring people about the background and the process and the procedures and the policies, in short, the Chancellor will need more money. Therefore, he is going to have to change the tax rules. They will have to increase the tax in order to pay for the changes to the system, plus the exit fee that we are having to pay the European Union. So tax rates will go up. I'm sure the government doesn't want to scare people right now and say everything's fine, we're going to be okay. I'm sure we are going to be okay, but tax rates will change. And the most easy target, Beth, is property investors, because they are the greedy so-and-sos who always take, and make so much money, and are such bad business owners. They take advantage of all of their tenants.
We've heard it all.
And some property investors out there who are driving all these flash cars, living in big houses, wearing these flashy suits. I mean, I've not come across any of those, just so you know. But those who are out there, I think the Joe public thinks every property investor is like that.
It's like the stereotype, isn't it?
Yes. So let's really grab them and let's really hit them hard. So I think that the Chancellor will think, let me start with property investors and whack them a bit more. Forgive me for using loose language. Whack them a bit more, because they seem to be an easy target. So why not start with them? Yes, but I do believe tax rates will go up if we leave the European Union.
I guess it's easier as well to get the public on board more with tax rises by aiming for property investors, like you say.
Low-hanging fruit, nobody likes us, so let's grab them, and it's going to be really popular. And look, I've done well. I've still not shared my opinion about whether we should leave the European Union or not. And I don't intend to.
I won't ask you that, don't worry.
Because otherwise we're going to end up in a fight here, aren't we? Yeah.
It's on politics, Snow. So the next one then, this one's quite a good one. It's, do different property strategies have different tax percentages?
That's a very, very good question. And anybody who's been on my half-day tax course will recall that I spent about 45 minutes talking about the difference between a trading business and an investment business. And I also talk about the pros and cons and the benefits of being a trading business. So let's assume both are running through a limited company. Both pay the same rate of tax, but a commercial conversion business or a serviced accommodation business is treated as a trade. So they have certain tax advantages. The two main common ones are when a commercial conversion investor wants to cease trading or wants to stop, and let's say they've built up £500,000 in their business as profit, sat in the bank account, they've sold all their properties, they think I've had enough now, I've done pretty well, I'm looking to move to Marbella. Because they're a trading business, they can claim entrepreneur's relief as long as they meet those particular rules, and I won't cover those rules now, and they can take all the money out the business and only pay 10% tax. So from the £500,000, they'd pay £50,000 to HMRC, £450,000 goes into their pocket. Whereas if you're a standard property investor, buy-to-let investor, you would then sell all your properties, you've got £500,000 in your bank account, and you would pay at your personal rate. And if it's a personal rate of capital gains tax, so you'd pay 18%, if you're a basic rate taxpayer, once you become a high rate taxpayer, you'd pay 28%. So just under 30%. So look at the stark
That's
difference.
quite a jump.
50,000 versus about 130,000 pounds. Massive difference. And obviously, as that number gets bigger, the share of the tax gets bigger too. The other big benefit right now for people who are into commercial conversions, I think, is using investors relief. So if you're looking for investors, what you do is on day one, ensure that when you set up your limited company, give them shares from day one. So they have to subscribe to the shares from day one, and they have to keep their money in the company for 3 years. And after 3 years, they can take all their money out, okay, and only pay 10% tax. Now, Entrepreneurs Relief has a lifetime limit of £10 million. So I've used the example of 50,000, but you've got a £10 million lifetime limit. Then Investors Relief also has a lifetime limit of £10 million. So I could come to you, Beth, and say, I've got this particular commercial conversion, why don't we do it together? One of your questions will be, how much profit am I going to make? How long will it take you? Let's assume and agree it takes 18 months to do that deal. 18 months, we do that deal. I say to you, Beth, we've made £500,000 profit, 250 is yours, you're going to have to pay a wad of tax. Why don't you leave your money in here for another 18 months? Let's do another deal. At the end, rather than having made £500,000, on the second deal, we'll make a similar, or let's say the same amount of profit. So we'll have £1 million in 18 months, £500,000 is yours. You'll just pay 10% tax, okay? And you can do whatever you like with the money. The benefit for me is I'm more likely to attract you as an investor, and I'll keep you locked in. I say keep, but you'll be encouraged to be locked in to that limited company for 3 years as opposed to 18 years. So I now have to kiss less frogs and find less investors, because I've got people like you who are investing with me on average for 3 years or longer.
It's a win-win, really. It's more appealing for everyone involved.
Absolutely. So why wouldn't you do it?
That's great. And then the final question that we have here was, can I set off renovation costs prior to letting the property?
That's a good one. You can set off some pre-trading costs, but generally speaking, you have to be running a property business to be able to set off your costs. So if you're doing major improvements, you cannot set those off. But if you don't have a bit of minor work within the last couple of months, then fine. But if your property is putting you in a position to be able to rent that property out, and you have to do that work in order to do that, then you can't set off those costs.
Okay, that's nice, clear,
but
simple.
But
that
there
one.
are some costs that you can claim for tax purposes.
Just got to do a bit more of your own research, guys, and really look into it, do your due diligence.
What I will do is I will write a blog for you, Beth, on pre-trading expenses, and you can share that on Facebook or on your website.
Yeah,
as you know, I'm not that good on social media, but you are, so
we'll get that everywhere. That's really helpful.
We can have a tag team here.
I like it. We should make that a joint venture.
Absolutely. Yeah.
That's brilliant. So that was all the questions that we had from everyone prior to this. Do you want to run through any of these extra ways of saving some tax while we still have time?
Absolutely. Why not? So the other big one, especially if you're into commercial conversions, is capital allowances. So these are allowances, or this is an allowance which is linked to inherent features within the building. So I'm looking around in this office to kind of share with you. So your aircon unit here, your sound system, your lighting system, your fire alarms. So anything fixed to the building is a capital allowance. Okay. And so if let's say you paid £1 million for this building, I come in, survey the building, and say you've got £200,000 worth of fixture and fittings, which we can claim for capital allowances. You can write those off for tax purposes. So using our early example of where somebody's made £500,000 profit, okay, you've got the £200,000 that I've shared with you, which you can write off, okay, over a number of years for tax purposes. But it gets better. If once you've bought the building, you've then refurbished it to bring it into a position to be rented out as serviced accommodation. any new expenditure which is classed for as a fixture and fitting for capital allowances, you can write that off for tax purposes too.
Okay.
Now previously it was £200,000 a year, but in the budget last year the Chancellor relaxed the rules. So from the 1st of Jan this year and for the next 2 years, if you spend up to £1 million, okay, on capital items, you can write them off in the first year.
Wow.
So rather than £200,000, you're writing. So what you're doing is you're accelerating, you're speeding up your allowances, writing them off early. You could create a loss and then carry that loss forward in future years and not pay tax for quite a number of years, so long as you hold on to the asset. Okay, so that's a massive one. Why is the Chancellor doing that? Because he wants to encourage people to invest more money. Okay, and in order to do that, he's relaxed the rules on that. So everybody, anybody out there doing service accommodation, keep an eye out for capital allowances and any new capital allowances that you claim for fixtures, fittings, repairs, refurbishment. Please make sure you write them off in the first year, which up to £1 million. That's a big bonus. Now we could talk about LLPs and limited companies and how capital allowances work, but that will take me a long time, and I think I might end up confusing people without a flip chart, because anybody who's heard me speak knows a flip chart or a flip charts are my best friend. I usually have slides, but I go off the slides, Beth, and I'm on the flip chart. I love the flip chart.
Well, going on to that then, so if people do want to find out more information, they want to hear more from you, where can they go, what can they do, where can they find you if they want more information?
So I'll finish off the point on capital allowances.
Go ahead.
So if you're serious about service accommodation and you're going to buy lots of units, or it works for you, seriously consider having a sole trader, a partnership, or an LLP to run that particular business, because with capital allowances it's going to become, it is a game changer, and it gives you access to a lot of cash. Okay, so it's important that people look at that very carefully, because most people don't claim capital allowances. They don't know about it. They go to speak to their conveyancing solicitor. He or she says go to speak to your accountant. Accountant says go and speak to your solicitor, and it really is confusing. So A, ensure you claim them. B, ensure you have the right structures so that you can make maximum use and benefit of capital allowances. If anybody wants to get in touch with me, what they can do is obviously call Progressive. I have a half-day tax course, and we did one yesterday with I think 117 or 127 people
so busy.
in the room. It was manic, wasn't it?
It was fantastic.
It was good. It was real good fun. So they can come on the half-day tax course. They can go onto my website, which is www.aa- which is the hyphen accountants.co.uk. Or they can call me on Peterborough, which is 01733 555 667. But I think the best way to do it is to contact you guys, and then come on the half-day tax course, because there's so much that I share. It's mind-blowing. I was knackered yesterday. Simply because with 117 odd people in the room, there were people who were firing away so many questions. It makes it really interesting and exciting, because I think the important moment for people is when they see a live example of somebody asking a question and see how the rules are applied. Because it's reasonably easy for me to share the rules, but it usually goes in one ear, out the other. But when we've got live examples in the room, that's a game changer. At the start yesterday, last point on this, I asked people how much do I need to demonstrate I can help them save, and there was one chap there who said £600,000 because I've got this particular stamp duty issue. At the end, by 1:15, 1:30, he said, "You've sorted my £600,000 stamp duty issue out." £600,000.
That's amazing. That's great. Of course, we can pop all that information down below if people do want to come along to the half-day training, as well as your details in there if they want to contact you as well.
Delighted.
But this has been fantastic. It's been really mind-blowing for myself, because I'm someone who gets very confused by a lot of numbers and everything, and I think you've explained it really clearly and in simple terms that it makes sense.
You're the first person to say that, Beth.
I really think, because when I think of tax and all this jargon that's thrown around, to me it's really complex, But the way that you've explained it and with those examples, I feel like you've really simplified it. And I know it's not always that easy in real life, but for an example, I think that was fantastic.
Oh, I'm going to share an insider secret. Tax is really easy. So when we're trained, Beth, they train us to make it really complicated. So we confuse people. No, that's a bad joke. That's a bad joke. It really is simple, but usually accountants are boring, dull and dry, usually. So we end up making it more complicated than it is. So if I've simplified it for you, I think I've done a reasonable job. And I've shared probably 17, 18 tips. So I think what I should do is come back and share the others. Because I've got 78 here. We should do a second episode.
I think 100%.
In February or March or whenever you like or whenever the audience wants me to come back. And let's share all the other tips too.
Yeah, that sounds fantastic. And I'm sure everyone watching will be really excited for that and appreciate that too. And we'll look out for the blog post.
Super duper.
Fantastic. Well, thank you for coming in
today,
Shaz.
Thank you everybody for joining us.
Yeah, thank you everyone for watching. And we'll see you next week. Bye,
Take
guys.
care. Bye-bye.